A company sits on a pile of ambition and zero public money. They need capital. Not a loan, not a favor, real, scalable capital. So they do something most people never think about. They create something from nothing, they turn ownership itself into a product, and sell it to strangers. That product has a name. You've heard it 100 times. It's called a share. And the moment it first gets sold to the public, that event is called an IPO. IPO stands for Initial Public Offering, the first time a company sells shares publicly. Before that day, the company is private. A few people own it, quietly, with no market price. After that day, millions of strangers can own a piece of it, and a price appears on a screen. That transition, private to public, is not a celebration, it's a transaction. A man named Marcus built a logistics startup over 7 years, reinvesting every dollar. One morning his banker calls. "You're ready," he says. "Let's take it public." Marcus doesn't fully understand what comes next. Most founders don't. Here's what actually happens behind that IPO headline nobody explains clearly. The company hires an investment bank, called an underwriter, to manage the whole process. The underwriter's job is to price the shares, find buyers, and take a fee for the risk. That fee is often around 5 to 7% of the total amount raised, not a small number. On a $400 million IPO, the bank walks away with roughly $20 million to $28 million. The company files a document called a prospectus, hundreds of pages of financial truth. Revenue, debt, risks, lawsuits, everything. Regulators require full disclosure before anyone buys. Most retail investors never read it. The institutions always do. Now here's the part that quietly frustrates a lot of smart people. You hear about an IPO, you want in, you try to buy, but the price already jumped. That's because institutional investors get access before the stock hits the open market. By the time it's on your screen at $38, they bought in at the IPO price of $22. That $16 gap on day one is not luck, it's structure. It's how the system was designed. Now, what happens when a company that's already public needs more money later? They've already done the IPO. They can't do it again, so they do something called an FPO. FPO stands for Follow-on Public Offering, a second round of shares sold to the public. Same company, same stock exchange, but new shares created and offered to new or existing investors. There are 2 types, and the difference matters more than most people realize. The first type is dilutive. The company creates brand new shares which shrinks each existing share's slice. If you owned 1% of a company and they double the shares outstanding, you now own 0.5%. Your share count didn't change. Your ownership percentage did. Quietly. Legally. The second type is non-dilutive. Existing shareholders, like founders or early investors, sell their shares. The company gets no new money from this. The selling shareholders get the cash instead. Both look identical on a financial news headline. They're completely different economically. A guy named Derek held 40,000 shares in a mid-cap firm he'd tracked for 2 years. The company announced a follow-on offering. He celebrated. 3 months later, he checked his dilution. He was still holding 40,000 shares. But earnings per share had dropped noticeably. He hadn't been told why. He didn't lose money from fraud. He lost value from math, quiet, legal, structural math. Now shift the entire picture. Forget equity. Some entities don't want to sell ownership at all. Governments, municipalities, large corporations, they need capital but don't want to give up control. So they issue bonds instead. A promise to repay borrowed money with interest over a fixed period. A new bond issue works similarly to an IPO in structure, but completely differently in logic. The issuer sets a face value, say $1,000 per bond, and a coupon rate, say 5% annually. You lend them $1,000. They pay you $50 every year. At maturity, they return your $1,000. That sounds safe. And sometimes it is, but the word promise is doing a lot of work there. A bond is only as good as the entity behind it. That's where bond ratings come in. Independent agencies assess the issuer's ability to repay and assign a letter grade to the bond. High grade means lower risk, lower yield. Lower grade means higher yield, higher risk. Some people call low-grade bonds high yield. The market used to call them something more honest, junk. Here's the misconception that even financially literate people carry around without questioning it. They assume IPO price equals fair value, that the number on launch day reflects what the company is worth. It doesn't. The IPO price reflects what the underwriter believes institutions will pay that morning. It's a negotiated number built on roadshow reactions, comparable valuations, and controlled scarcity. A company worth $800 million by internal metrics might price its IPO at $600 million deliberately. That discount creates the first-day pop. Shares jump. Headlines read, "Successful IPO, everyone looks good." The company left $200 million on the table. The institutions who flipped their shares collected it. This isn't corruption. It's incentive structure. Understanding the difference changes how you read every IPO story. Now, before a bond even hits the market officially, something quiet happens in what's called the gray market. Large players begin trading the bonds informally, before settlement, before listing, before retail access. By the time the bond is available to you, its effective yield has already been partly priced in. You're not getting the original terms, you're getting whatever the gray market left behind. A pension fund manager named Samir spent 11 years watching retail investors misread new bond issues this way. They'd see the coupon rate, feel comfort, and ignore where the bond was already trading post-gray market. The coupon is fixed. The price is not. When price rises, effective yield falls. That math never changes. So you buy a 5% coupon bond at $1,100 instead of $1,000. Your real yield is now closer to 4.1%. You didn't get cheated, you got confused by a number that looked stable but wasn't the full picture. This is why professionals talk about yield to maturity, not just coupon rate. Same bond, completely different story. Now pull back and look at all three: IPO, FPO, new bond issue. As a single system, they are all answers to the same question: how does an entity convert future potential into present capital? Equity offerings sell ownership. Bond issues sell a promise. Both monetize trust in different ways. The underwriter in all three cases is essentially a bridge, connecting the entity that needs money to those who have it. That bridge charges a toll. Always. Sometimes visibly, sometimes buried in the spread between buy and sell price. In a new bond issue, the underwriter often buys the entire issue first, then resells it at a slight markup. That markup, called the underwriting spread, is how the bank profits without appearing in the headline number. On a $500 million bond issue with a 0.8% spread, the bank earns $4 million before you see the bond. The issuer knew. The institutions knew. The retail buyer reads the coupon rate and moves on. None of this means the system is rigged against you specifically. It means it was built for volume players first. Knowing the structure doesn't guarantee better outcomes. But not knowing it guarantees you'll misread the signals. A 35-year-old named Joel bought into 3 IPOs in 14 months based entirely on media coverage and excitement. 2 underperformed their IPO price within 6 months. 1 recovered after 2 years. His average, roughly flat. He didn't lose everything, but he spent 2 years underwater on money he thought was working for him. The question worth sitting with isn't, was the IPO good or bad? It's who was it designed to reward first. If you can answer that cleanly, you can read the next offering with clearer eyes and less noise. So this week, find one recent IPO or bond issue in the news and pull its prospectus. Just the first 10 pages. Look for 3 things: who the underwriter is, what the fee structure looks like, and who the anchor investors are. You don't need to understand every line. You need to see whose name appears before yours in the money flow. That order tells you more about how a security is born than any headline ever will. If this helped you think more clearly about how capital markets actually work, the next video goes deeper. We'll look at what happens after the IPO, secondary markets, price discovery, and why most stocks drift downward in year 1. Capital isn't created, it's redirected, and the people who understand the pipes always move faster than those who don't.